I'm on a mission to help 200,000 practice owners achieve financial freedom. I'm Eric Miller, author of How to Become a Financial Beast. Download my free book today, A Practice Owner's Guide to Personal and Business Wealth You Never Thought Possible. Hey, welcome back to the Financial Beast Podcast. I'm your host, Eric Miller, co-owner, chief financial advisor at Econologics Financial Advisors, along with
Eric Gersh,
financial advisor
extraordinaire.
Yeah,
we help healthcare owners achieve financial stability and growth by offering premier financial advice and guidance. Make sure that you check us out at econologicsfinancialadvisors.com. It's a brand new website. It's pretty awesome.
It is.
And as a reminder, if you're new to the channel, please like, share, subscribe. You know the drill. We need more people that are getting this data, especially if you are a practice owner or an associate. All right, here we go. So I had an investment meeting today.
Yep.
Okay. And I'm sure you've had investment meetings as well.
Oh, yeah. I did one today as well, actually.
With people. And
yep.
I do like doing them, but I still am always kind of fascinated by what people are viewing as a success when it comes to an investment. And, I remember when I was doing like intro calls with people, like introductory calls with people, like the moment that I knew that they were a complete novice and a rookie when it came to the financial game, especially with investments, when their first question when it came to investments was what?
What's the rate of return?
What's the rate of return? What's the rate of return? That is the first sign that you're dealing with someone that has basically gotten their investment knowledge on, I don't know, Google. Yeah. Somewhere around there. So I think we should dig into that. Not that performance isn't important.
Oh yeah, no, of course. That's why we invest.
But like people never ask any other freaking questions.
No.
Besides
and
that.
that's what gets them in trouble, is not asking the other questions, because performance is only, part of the wheel, if you will.
Yeah. Yeah. So I thought we'd dig into that a little bit today and maybe go through some horror stories of where people violated some basic principles of investing.
Let's do it.
And yeah. So, all right, where do we want to start with? Let's start with some of the bad experiences that people have had.
Okay.
With investing. I mean, I have like two that I can think of right now, where one person that put money into a real estate endeavor. Okay. Put money into a real estate endeavor. And of course, there's all these promises that are made that, this thing is going to return, 2 times what you put into it. You're going to be getting, mailbox money payments. And, 8 months later, 9 months later, people are getting capital call requests, which basically is that the project was so underwater that they're now requiring the investors in the original investment. Hey, if you want this thing to like save itself, you got to put more money into it.
Right.
You got to love those.
We've done so well that you need to put more in, or
exactly.
You're SOL.
Exactly. And then eventually the guy lost all his money.
Yep.
You know? And I know this happened like 3 years ago. Now, like this was a perfect example of not looking at this thing and not even looking at the overall market, looking at interest rates, and it was pretty obvious that at some point in time, this thing was going to fall, and it did. And he lost, $600,000.
Yeah, I'm trying to think of my own horror stories, and I think that there's...
Well, how about people that have just like had money in the markets and then just sold at the very bottom?
Yeah, that's more so an emotional decision, I guess. I mean, of
Yeah.
course, that's a horror story, right?
Yeah.
You cash out when you're low and you never get a
I've done
chance to come back
that, but I've done
up.
that before.
Yeah.
I did that before.
Yeah, because people manage, even us, we have that emotion connected to our own money, and it's hard. I know factually what I should do,
Yep.
but when you're touching your own, like literally your own account, sometimes it's tough.
There's no doubt about that.
So, but yeah, most of the horror stories that I have seen and hear, they largely come from the private investment market.
They do.
Because there's no, like when you buy something on the New York Stock Exchange or whatever through your Vanguard account, it's been through rigorous due diligence. When you invest in some fund put together by two guys that tell you they know how to manage apartments,
Yep.
it doesn't go through the same due diligence. And believe it or not, it's significantly higher risk than investing in the stock or bond market.
Oh, there's no doubt about that. I wish I had the stat on all the private deals that are out there, and the percentage of those that actually go belly up and fail.
Yeah, because clients always come to me or us, and they have these private deals, and it's going to give me 8% per year or whatever it is, and it seems safe. But I always remind them, like, number one, you have to be an accredited investor, so you have to have a net worth over $1 million, basically, or make over $300K a year. Why do you think that with this fund, you have to be an accredited investor? Do you think because it's higher risk than the market or lower risk?
Yeah.
Well, it's higher risk. And that's why the SEC only wants people who basically can afford to lose money to be invested in the thing.
Yeah. It's so true, man.
But people don't see it that way.
No, and I get it. I think it's the excitement of doing something that's completely different than what has been, kind of the norm or the standard that you've seen people do for, forever.
That's exactly what it is.
And it's you
feel special.
Yeah. And it's that, and it's like, it's the potential, like, man, this thing could pop and I could make a boatload of money.
Yep.
You guys, you're just not swimming in the same circles as those people that are actually able to take advantage of those kind of private deals. And so I remember I had one client that he could not stop doing private placement deals. Like it's all he could do. And I'll be honest with you, I bet you he pissed away at least $1 million.
Really?
Okay. Easily. All right.
Wow.
And every time he went into it, it was like, I know I messed up, but it was like almost like a compulsion. Now he eventually broke that compulsion. Thank God, but it was wild, man. I mean, it was just like looking at all of his investable assets. And usually when you're looking at like a client's balance sheet and you see their investable assets, you see their IRAs or their brokerage accounts, or maybe they have a life insurance or an annuity or something like that. It was all these I've never heard of these things before. I'm like, what is this? Oh, it's a private deal. It's a private placement.
Yep.
And dude, none of them paid out. None of them. He went like 0 for 10. Didn't even know you could do your odds were that bad.
Bad luck, but yeah.
And but man, it's I get it. I mean, these things come around. You're like, hey, it's exciting. The person that's promoting it is like really good at promoting.
Yep. It's exciting. It's there's only limited space.
Yeah.
It's only available to people like you.
Oh, I had another one. I had an ex-girlfriend that put $250,000 in like a gold. Oh God, what were they trying to do? I don't know. They were trying to do some gold refinery, something. I don't know. And I'm like, what are you doing? And well, I was like, okay. Well,
That's
her and
a new one.
another guy I knew put 50,000 in there, lost. It's just, it was crazy.
That's a new one for me. Gold refineries. I haven't heard of that yet.
And look, gold is generally a good investment. I mean, it was up, I don't know, 10, 12% last year.
Yeah.
It's at all-time highs right now. So I'm not saying, but it was like the private deal was just a sack of potatoes.
Yeah,
you
buying
know?
a piece of gold and holding it is a lot different than
Yeah.
starting a refinery.
Yeah. So look, you guys got to like have some kind of a system that you go through when you're analyzing an investment. Now, I can tell you that, we work with some uh, investment platforms, and we've been around a lot of like what I would consider professional money managers and things. And I'm going to say it comes down. There's like 4 P's that you can use as like a basic scorecard. Okay, to determine whether or not something would be something you want to invest in or something that you should probably stay away from.
Okay.
So I want to go through those 4 P's, like P as in Paul. Um, and then we can like talk about how you would apply that, how you would look at that, and where we've seen it go right and where we've seen it go wrong. So I think the first thing that you got to do is when you're looking at an invest, and this isn't just me saying this. This is like I think how professional investors and money managers operate.
Yep.
Okay. The first thing that like how Warren Buffett would operate. Okay.
Yeah, exactly.
Like, okay, the first thing I'm going to look at is the first P is the people.
Yep.
Right. So this would be no different. Like if I'm going to go buy a vet practice, or if I'm going to go buy a dental practice, or whatever it would be. And
Hey,
I'm
you're
looking
look at the staff.
I'm looking at the staff. I'm looking at the people involved in this investment. Okay. And, if you have a culture that's terrible, where there's a bunch of infighting, number one, the numbers are probably going to reflect that. But if you're going to deal with especially if you're trying to do like a private investment, man, I'm looking at that person. Who are the people doing it?
What's their history?
What's their history?
How many, if they're doing an apartment complex, or if they're doing a gold refinery, how many gold refineries has this person actually successfully opened, sold, and, what's their track record?
Yeah. That would certainly be part of it, but just
also another one real quick. I don't mean to cut you off. Another thing, and I can't remember the exact example. This was probably a year ago, but there was a private deal that all the money got taken out of the country.
Really?
And it came out after the fact that the head guy in the deal had some sort of embezzlement or some sort of financial conviction in his background.
Yeah.
And no one knew because no one actually looked into him.
Yeah. Well, how about a background check on the person?
Yeah.
Yeah,
he was a convicted felon. I mean,
yeah. I mean, how about a simple background check on the person?
Yep.
And just making sure like that the person is a person of actual goodwill, that they're competent, that they're not just good salespeople.
Yeah.
But and look, I mean, not everyone's perfect. Not everyone's going to be a saint, but look, I mean, you still have to do that, that due diligence on the people.
Yeah. Investing in someone or with somebody who has an embezzlement background or a fraud background is a glaring red flag. It's not like they got a DUI 24 years ago when they were in college and, have been an upstanding citizen since.
Yes.
Big difference between the two.
Yes. So that to me is going to be, I think pretty important is you got to know who the people are involved in the project.
Yep.
Okay. Second is going to be their philosophy. Like the second P is going to be their philosophy.
Okay.
Like I think if you're going into an investment, I got to know the story behind it.
Yep.
What's the philosophy? Like if you're going to invest in an ETF or a mutual fund with, someone, don't you want to know what their investment philosophy is?
Yeah, and every fund, whether it's a private or a, publicly traded fund, they should have a philosophy. All the publicly traded ones do. They basically have guardrails built in, and you can easily find this information on like Morningstar or Yahoo Finance, but there's guardrails built in as far as like, okay, maximum equity exposure is this, and the information's there if you look for it.
Yeah. It's right. Like what's our philosophy? Well, we believe markets are efficient and that over a long-term period, if you are fully invested, you're going to be able to garner an 8 to 10% return. I mean, you may not agree with that, but that's a philosophy. Okay. Yep. Another philosophy would be, we feel like we can take advantages of certain segments of the markets based upon this story. Okay. You may not like that, but it's a philosophy.
Yep.
All right. Another person may say, I believe that rental real estate is going to consistently turn out blank amount of return. If you buy them in this particular area, my philosophy is that if you buy these types of projects and blah, 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 blah,
yep,
like then you're going to more than likely get your money back. That's a philosophy.
Yeah.
Okay. It's a story and a belief behind the investment, whatever that would be. And you have to know that person's philosophy. And it's a question that you should ask.
Yep.
So, I mean, I kind of think our philosophy has always been, in terms of investing, is that nobody, I don't think there's a perfect investment.
No.
Right. And that's why we've been always open to insurance-based contracts, real estate, stocks and bonds, all those things. That the ability, most of your wealth is going to be created. Like our philosophy is, most of your wealth is going to be created in your practice. Okay, and it's your job as an investor to make sure that you're taking percentage of the profits, putting that away into investment vehicles that are going to pay you back at some point in time. Now, what's done that? Real estate, insurance-based products, stocks and bonds.
Yeah.
Okay. That's a simple philosophy that we have.
Yeah.
And I think that's what's missing from a lot of people, is that they don't know the story behind, how people approach investments.
Nope. They just want the next shiny thing.
Yeah. So next one I think would be a process. Okay. How do you do it?
Yeah. Yep.
Like, how do you go about, like, if you're a real estate person, what is your process for evaluating the property? What is your process for underwriting the deals? What is your process for securing the loans?
Yep.
What is your process for all these things? What is your process for when things go wrong?
Yeah, and if you're like an ETF, what is let's say you're a biotech ETF, how do you analyze companies to see which are good investments? Is there, benchmarks on how far they have to be in FDA trials? I mean, process is going to dictate to some degree performance.
For sure. But I think you'd want to understand that, like, what is the process for you producing your product?
Yeah.
Okay. And what are the controls that you have in? Okay. What are the quality controls that you have in?
Yep.
What are the things that you're doing to make sure that you're minimizing the risk of producing your product at some point in time? And everyone's got to have a different process.
Yeah.
Okay. But to your point, these are the things that we're doing to make sure that the likelihood is that this investment is going to be successful, or at least you're going to get your money back, at some point in time. So, everyone has to have a good process and explain it really, really simply and easy.
Agree. The process is, well, I don't want to say it's the most important part, but it's, I would say the second most important part behind the people involved.
I would say so too. Like, if even from running a practice, like most of the healthcare owners, like, what's your process for running your practice?
Yep.
All right. Well, what do you mean our process for running the practice? Oh, do you have an organization board?
Yep.
Okay. Do you have job descriptions? How do you greet people? What's your I mean, these are all processes that you set up.
Yeah. And all these processes are going to, in your practice, dictate whether you're successful or not.
Yeah. Or no, we just kind of wing it and, see what happens and we'll go from there. And it's like, all right, well, then
people just show up, kind of do their thing and go home and,
I mean, you can do that, but no one's going to want to pay for that or going to want to invest in that. So, I mean, when healthcare owners get approached by private equity, I mean, they do go in there and look at your processes.
Oh yeah.
All right. Now, by and large, they know what those processes are already because that's why they're in the industry, and they know that they're going to make them a lot better than what most people are doing.
Yep.
Fact. But yeah, is what it is. Okay. And then the last one's simple.
Performance.
Yes. Performance. Okay.
How has it performed?
Yeah. And I'm sure it's going to be relative to something, isn't it?
What do you mean by that?
I mean, you just can't well, what's your performance been compared to what?
Oh yeah, yeah.
You know? Like that's that's another question that I laugh at is like when someone say, "What's your performance been?" Well,
yeah.
Compared to what?
Exactly.
The market.
Exactly.
Which one? You know?
And I see this a lot. This is one area that I think people don't fully understand, and it is our job to educate them. But I get questions a lot about performance, and people always reference the S&P 500.
Okay.
Which is fine.
You
know,
it's an index.
But if you're 60 years old, 65 years old, and you're retired, we're not even remotely attempting to match the S&P 500 index.
No.
Right? The S&P 500 index is 500 American stocks, 40% of which are tech stocks, right? That's way too much risk for someone who's 65 and retired.
And as I learned today, was driven, yeah, you're right. 40% of the performance was driven by 7 stocks.
Oh, yeah. Oh, it's completely top loaded by the big stocks. Tesla, Amazon, Facebook, blah, blah, blah.
Yeah.
Yeah, they're driving the performance. It's not the 490 other companies.
Nope. Which then gives the person why don't I just buy an index fund? I don't need anything like that. Well, what happens when those stocks go south?
Yep.
Which they will at some point in time.
Everything's cyclical. Yep.
So,
but performance is important, but you also have to be cautious. Like, as you know, just because something returned X percent in the past does not mean it's going to return that in the future.
No, a lot of real estate people in 2021 learned that lesson very, very well.
Yeah, everyone looked like geniuses when interest rates were low.
Yeah, exactly.
When rates shot up, suddenly
all those
you weren't
real
printing
estate
money
deals,
anymore.
All those real estate deals that were projecting, 15% annual rates of return, went down to 3, if that. Most of them couldn't even support the debt, and then they went bankrupt.
Yeah, and there's so many examples, not just in the private, but public markets. I mean, Sears, J.C. Penney's, all those cornerstone American names that don't really mean much of anything anymore. But 50 years ago, they were the Amazon and Facebooks of today.
Yeah. So all these things are going to
it's an evolving world.
It really is. Yeah. And, you need to have something where some kind of a system that you guys are evaluating things. And, performance again is great. We have to look at it. Of course, you want everyone to perform relative to, I guess, some kind of a benchmark or an index or something like that. But there's still not, it's the last thing I would probably look at, to be honest with you. I'd be much more interested because if you got good people, if you got a good philosophy, a sound philosophy, if you have a good process, the probabilities is your performance is going to probably rank in the top percentile.
Yeah, your performance will be there if those other 3 things are. Yeah, most of the time.
So if the performance isn't there, I'm kind of circling back to say, what did I miss?
Yep.
In the other categories right there. Like, was there something I missed right there? Okay. But you guys have to know what you own and why you own it. All right. And I can tell you, a majority of people just don't. They don't know what they own and why they own it. Okay.
And I do think, too, it's fair to say, like our clients that are actually currently working with us, they rely on us.
For sure.
For a lot of this process because they don't have time to do it. But you definitely, if you're managing your investments yourself or making decisions yourself, these are things that you can't offload to somebody else. And even if you do work with an advisor, whether it's us or someone else, you still should probably spot check this stuff at least.
Yeah, I would say so.
You don't have to do the whole job, but you still have to check in.
I mean, look, we have to look at personal holdings. We have to look at, individual holdings for. Now, look, I just went over again. I went over a client investment portfolio today. Okay. And they had, I'm going to say it out loud. It was over $10 million. Yeah. All right. That's not average. I wish, but I know you do too. But it was, but we broke it down in different categories. Like, here is your fixed income holdings. I didn't go through all friggin' 100 and something fixed income holdings that they have.
No, you'd be there all month.
Right. But I went through the type. This is the type. This is, what the projection is. This is why we own these.
Yeah.
Okay. Same with the equity portion. These are why we own these stocks. Okay. And this is all blended together. This is how this portfolio is going to provide the income that you need based upon where you're at this particular point in life. And this is how we're going to manage, the risk as well. Okay. And that's what I'm talking about, knowing what you own and why you own it. You don't have to get down to the granular of every single security. If you want to, it's probably good. But just know what is inside of your stuff, of the thing. Well, I own a mutual fund. Great. Why? What kind?
Yep.
What's inside of it. And I think that'd be a good exercise for everybody to do that. But you got to know your numbers. That's for sure.
Yep.
Okay. People.
Process.
People, process, philosophy, and performance. Or no, people, philosophy, process, and performance.
There we go.
4 P's, buddy.
4 P's.
All right.
Until next time.
All right, guys. See you on the next one.